So moving on and talking about the market and what happened last year in 2020, it certainly began very differently how it ended, didn't it? I think at the beginning of last year, we were tracking 40 billion worth of capital ready to invest dry powder into central London. And obviously, we all know what happened with COVID, but it's very easy to forget what happened at the back end of 2019.
Yeah, it's really easy to forget, isn't it, with everything that's gone on? But it's important to remind ourselves where we started in 2020, because it provides some context, especially from a capital markets point of view, and then in the value add market, people's assumptions on exit for these projects. But we, as a team, you'll remember that busy period we had going, kind of coming out of the general election at the back end of 19, coming into January 2020. And over that period, we conducted a number of sales that happened pre-Christmas 19. And we were aware of certain investors putting bids in on assets, for example, in Farringdon, at below 4% yields, which would have, none of them came off, but if one of those owners had accepted that and executed that deal, we would have looked at a new benchmark in Farringdon at over £2,000 a foot. And that sentiment is very easy to forget, isn't it? Post March.
Yeah, and the first real asset that came into the market in 2020 was 90 Bartholomew Close, which is something I was looking at keenly. I think that's one of the best illustrations of the year. WALT of 5 years, guiding just over 44 million. A brand new development up and let, brilliant scheme. Um, they conducted 60 inspections for that, with a whole host of capital looking at it, whether it be European, UK, propcos, and it eventually sold for 3.9% to an overseas investor at the second time of asking, which I think shows the depth in the market, as you were just saying, about what happened at the back end of 2019 and being relayed into 2020. What follows was, as everyone knows, the fallout from COVID-19, the national lockdown, which was called by the government. We estimated that there was nearly 4 billion on the market across the West End and the city on the market at this time. Assets were quickly withdrawn, or deals that were progressing or under offer subsequently fell over, with buyers suggesting nervousness around lockdown and uncertainty that the virus would have going forward. And as a result, only just shy of 600 million transacted in Q2, the lowest on record. And only really signs began to sort of unravel itself towards April and May, when actually something, Andrew, you looked at closely, 60 Aldgate came to market.
Yeah, it was a really interesting time, wasn't it? Because you had that sentiment going into January, February, and that from a development value add point of view, probably culminated in the sale, Bridges Fund Management selling Quicken Tower House, which is an unbelievably amazing site just north of the city in Shoreditch on that boundary. Um, and that captured that really positive sentiment that was happening in the market. And then we had this complete withdrawal of assets from the market, didn't we? We had this shutdown over March, April, and we were kind of sitting there waiting to see what would happen, how the market would react. Obviously, talking to a lot of clients and investors at that point. But one asset that then came to the market, I think back end of April on the value add side, was the sale of 60 Aldgate. For those that don't know, it's 200,000 square feet. At the time, it had a consent, although you had to go in for a slightly different consent, but a new build development opportunity, which was launched into the market. And I suppose some people would have looked at that and thought, with the global pandemic going on and all the question marks around potential structural shifts from the working from home, the big experiment on working from home that was turning out to be quite successful at the time, was maybe it wasn't a great time to bring out an asset like 60 Aldgate. But we were advising an underbidder, an investor. We ended up being interviewed in the very final process of that. And the the process that it went through captured a lot of attention, and there was a huge amount of investors looking at that sale and underwriting that sale, and it culminated in 12 proposals being put forward. And okay, there was a big spread, like we know, of bids across those 12 investors, hugely positive for the market at that point. And from our point of view, our advice to our client, and our client was completely on board with this approach, was that actually COVID would accelerate this focus on best in class working environments. And actually, if you wanted to put your capital to work in London, creating best in class workplaces and offices would be quite defensive actually over the medium to long term.
It's really interesting, and I think it's following on that theme. One of the best examples, in my opinion, in the past 5 months that's happened in the market was our sale of 2024 Kirby Street, 22,000 square feet, freehold opportunity, short income until 2021, which on the face of it could scare a lot of investors. But it was now that we began to see rather the beginning of this trend to the flight to quality. Sale transacted 1.5 million ahead of asking. There were 70 viewings, 15 offers from 10 different nationalities. And this was the first time that we saw the occupational market, although it was weak at the time because people were working from home, investors willing to take this risk and this punt on the fact that yes, the building may be vacant short term, but longer term, if you were to refurb it and redevelop it and reposition it, it would be a good way to entice occupiers back to the market. And actually, Kirby Street was obviously a really useful sell for Knight Frank, but it sort of set the tone for what happened in the remainder of the year. To touch on some of those, one Great St Helens, an awesome building in the city, great location, income again until 2023, so short 3 years at the time, 51,000 square feet, virtual island site, refurbishment play. We believe they received over 7 bids, all around or ahead of quote. Amazing depth in the market. Another Knight Frank sale, 7 Soho Square in the West End. Fantastic freehold opportunity, 61,000 square feet in a really, really interesting location, that sort of Crossrail node, which everyone's been talking about for such a long time. And actually, this was another example of Crossrail, but really beginning to entice investors into it. Short income, again, a refurbishment play. They received over 10 formal bids, and actually it ended up selling over 4 million quid ahead of asking, which again, an amazing achievement given most people were working from home. And actually, latterly, at the end of the year, an example of a building transacting with no income at all, which I think really is probably my favourite example of the whole lot, because it illustrates that investors were just so deep in their analysis of providing a flight to quality and a view for their occupational market long term, is that people wanted good quality space. It was a vacant Royal London sale, amazing location next to Liverpool Street, 50 inspections, and again, nearly 10 first round bids. And whilst they were initially guiding 47.5 million, it eventually sold for in excess of 50. And these are all examples of more or less refurbishment plays, but I know there are a few other messy ones, Andrew, that you looked at as well.
Yeah, we had the benefit, didn't we, as a team, a really privileged position to be involved in so many of those value add sales that happened last year. But half of our time is also looking on the buy side for clients, and we were active on all of those, and it was a really busy period, that final quarter, underwriting deals such as Eden House, 7 Newgate Street, 135 Park Street, Fleet House, all of which we bid on for various clients. And the approach, the buy side approach from us and clients, was pretty bullish, and it carried on that trend that we saw, which started with 60 Oldgate High Street. Coming back to this, we're creating best in class office space, and if there's an opportunity to get hold of the whole building, reposition the whole building, create amazing back of house amenity, terracing on as many floors as possible, outside space, hotel style lobbies, receptions. These were the opportunities to put capital at work for those kind of projects. And actually, the underwriting response, the appraisal response from us and clients, I don't think really changed a great deal from what it would have been, say, in January, February. Maybe the steam came out of some of those that sentiment around the exit, but we never saw yields or exit yields being pushed out in those appraisals. In fact, we had quite a few conversations, many more conversations with clients about the potential for exit yields to come in over the short to medium term, just because the risk-free rate had come down quite substantially with all of the global central bank activity that had happened post-March. Rents for best-in-class space, especially some of these opportunities like 135 Park Street, where you've got terracing on every single floor, held pretty steady. I think really the only impact was probably on the rent-free, which tended to move out, depending on what kind of project you looked at, but let's say 3 months on some of this stuff. And the debt element was quite a big part of how the market changed last year. And whilst the risk-free rate came down, margins crept up. That kind of neutralised the cost of debt to a certain extent, but we did find that leverage levels came down a bit, and a much stronger focus on sponsor or borrower capability and track record. And we did find actually that lower leverage in the appraisals meant that the inclusion of debt on these projects wasn't as accretive as it had been. And for levered focused buyers, that made the market a little bit more tricky, a little bit more difficult in 2020.
So what trends can we pick out then? Obviously, we were very lucky as a team, weren't we? We had 6 value-add sales, over 300 sell-side inspections, and access to nearly 50 underbidders, an amazing book of knowledge and intel. I think one of the things that stood out for me was, yes, all those buildings that we've just described that sold were mainly because they were in the prime locations, but conversely, assets that weren't in locations that benefited from Crossrail or transport links, or didn't have a clean block date or lease expiry that was all aligned, they would then struggle. So secondary locations and that block date, I think, was one of the main trends that certainly I sort of looked at and viewed.
Yeah, definitely. I think there's a huge, like we've said, there's a huge weight of capital. There was a huge weight of capital pre-COVID. The lack of trying to target value add returns in London, the lack of stock that we saw during the first half, or probably actually during most of 2020, meant that deploying that capital became even harder. So the weight of capital there for value add product has only got more in our view. There's a real lack of supply for that product. And I think you're going to see probably going into 2021 pricing harden for some of those best in class opportunities. But you're right. I think the core plus part of the market, where you have a rolling refurbishment business plan, you have varying lease expiries, breaks. You're pushing performance via rent reviews, renewals, expiries, refurbishments, and especially immediate letting risk. If you've got immediate letting risk in some of those assets, that could be a more difficult part of the market in 2021.